From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Well, hello. This is the COB, all the stuff you need to know about the day in business and markets. I'm Nadine Blaney.
I'm Kyle Roder once again, and well, a slightly better day today, although I think that's 2 days in a row now that we're up. So heading into this big Fed meeting, very exciting.
Yes, it is very exciting, isn't it? It was a really positive session here locally today. Look, figures on the screen. Clearly the match out's still happening on the S&P ASX 200, but the CBOE Australia Index is closed up by 7, pretty close to 0.8%. Let's call it that.
Yeah, absolutely. And well, a fairly broad-based day of gains as well. Energy rebounding there. You can see the CBOE 200 on the screen, 0.77% higher. The ASX 200 up by 0.9% at the end of cash trades. So again, fairly buoyant going into this big risk event.
Yeah, okay, so we've got plenty to speak of in the next 20 minutes or so. Of course, this ASX bounce that we're seeing on the screen right now. Also, it's just all about the Fed, isn't it? The three themes today, the ASX bouncing, the Fed really looming. Gold down, it's just moving closer here. Gold down, but oil was up. So that sets us up nicely to just have a bit of a chat about the sectors of the day. And to your point, you know, all tech was actually the best performer. The NASDAQ has been so strong lately.
Absolutely. I think it was up 6% some last week thereabouts. Continued to rally last night. And you can see some of those maybe slightly higher quality stocks in our tech space. At the very least, we can see there. Computer share up 1.85%. WiseTech 0 by the dip there, I suppose you could say. And Block as well, because cryptocurrencies are at 28,000. So there you go. Double whammy there for Block. Okay,
so we have seen oil come off slightly in Asian trade, but energy, one of the best performing sectors as well. Woodside up by 5%. I mean, that's punchy, isn't it? Soul Patts, we'll talk about it later in the program, but that actually does report tomorrow. Looks like a bit of an odd inclusion here, but anyways, Beach Energy up by close to 5% as well. But one man's treasure soon has become another man's trash.
Yeah, at least for today. Gold obviously pulling back just a little bit, fell below $2,000 per ounce in US trade last night. So seeing that being reflected a little bit now, gold miners still up obviously over the last week and a half. That kind of duration story as well, I suppose you could say, as yields have fallen. But just for the session, Perseus Mining for one, down 4.58%. But broad-based losses for our gold miners.
Look, I think it's worthwhile still checking in on the banks. I mean, obviously strength with the big one there, Commonwealth Bank. Macquarie continues to make up some of the losses it experienced to start the week when we were still even more attuned to what was going on in the banking crisis. Look, just thinking back to the conversations that I've been having throughout the day today, started the day with a good one with James Garish from Shaw & Partners Market Matters, talking about hybrids. And you can find it online, ausbiz.com.au, just hammering home, you know, the fact that we still do have really safe as houses banks here, that the hybrids, he reckons, you know, are still sound, but you know, the conversation really has changed since Credit Suisse being forced to take over by UBS and those AT1, you know, hybrid bondholders really being wiped out.
Yeah, it's something that we've all had to brush up on, and of course, a lot of folks out there on Twitter and other social media pages now, experts in that area of the financial markets as well.
Like everybody's throwing out these cocoa bonds left, right, and center.
I wear cocoa all the time. But nevertheless, we certainly had to get across some of the fine print, I suppose. That was the lesson in some of those assets. Some certain covenants there that you want to be aware of in these situations.
Look, good chat with David Sokolsky from Maqro Capital today. He says he was a bit taken aback by the banking crisis as it unfolded. Of course, it feels as if these cycles are going really, really fast. But again, he was at pains to point out the difference between what's going on overseas, what's going on here. He does not think that the European banks look like good value here. He's looking more around the Asian region. Stock specifics, shall we?
Yeah, absolutely. National Storage REIT has launched a $300 million capital raise to provide funding flexibility for future acquisitions and to repay existing debt facilities. So there's one particular story for the day. And
we also heard from Star Entertainment Group. So its executives and its chair in a whole heap of trouble. So it's been named, Ben Heap, one of those directors to face civil proceedings from ASIC. So he is stepping down, will be replaced at the end of March.
Yes, and we also had KMD reporting today, down 6%, as you can see there. Although talked up trading conditions going forward, still not looking fantastic for the stock.
Well, it's the retailers, right? It's just still a lot of uncertainty. Obviously, we've got the Fed to get through tonight, how that will set the tone for the RBA as well. Latitude Financial, it clawed back losses after hitting an all-time low. It's come back online after being in a trading halt. After that massive cyber attack, the company continues to try to identify how many customers have been impacted. As you know, some of its customers are the likes of JB Hi-Fi. This is bad. And Harvey Norman, which was the stock of the day today. Do you want to know why?
Why?
Co-founder and chairman, Jerry Harvey, bought 72 million worth of shares over the past month. In the wake of its result, if you remember, Harvey thought we were all crazy for not going out and buying the shares. In the wake of that result, he said that investor reaction was a total overreaction because, of course, earnings were down 8%. We saw profit after tax also down about 15%.
Yeah, well, putting your money where your mouth is. Of course, we had Andrew Whelan from DP Wealth Advisory and Henry Jennings from Marcus Today on the call today. Here's what they had to say about Harvey Norman.
Would I be buying, or would I be suggesting my clients buying? I would not. I'm not suggesting that they sell. When it was over $5, I was saying they should sell. But I think there could be a little bit more pain, sadly, coming yet. So at best, it is a hold.
The problem with Harvey Norman is that it's just very complicated. There's lots of moving parts, but the overriding factor that stops me from going, oh, I'm going to follow Jerry, is the fact that we are entering a period where we're being constantly told the consumer is pulling back spending, that we've got this fixed mortgage cliff coming up, and things are slowing. So it's hard to get enthused on the back of that, not only from the property trust point of view, but also in terms of consumer spending.
Okay, so a double hold there from the fellas. But, let's get a view on discretionary spending in the economy now. Mark Gardner from Maqro Capital joins us once again on the COB. Mark,
welcome.
I feel like there's perhaps no better person to talk about consumer discretionary spending in the economy because, 9 mouths to feed on a weekly basis? It's roughly that. I mean, you'd be very, very well aware of the struggles and the travails, obviously, of trying to go out to the shops and keeping food on the table, as well as housing, all the rest goes into it. Clothes.
Threads.
From an investor point of view, as well as I suppose from a human point of view, I mean, how do you think the Australian economy is going to hold up? Because clearly Harvey Norman wants to put his, like I said, money where his mouth is.
Yeah, I don't disagree. It being a hold, look, it depends on your time frame. If these high quality retailers in the Australian, consumer discretionary sectors, JB Hi-Fi is the best revenue per square metre, and Harvey Norman's been around forever and high yield, and they know Nick Scali, they know their businesses, they're founder led. So look, if your time frame's a 5-year time frame, they do offer great dividends, and they are survivors. So and I think founder led, good management are really things you want to be watching out for. And obviously, if you've got Jerry Harvey coming in putting $72 million where his mouth is,
and he knows the books more than anybody
absolutely
else, right?
He does. So and you find like even Nick Scali, look, it's quite thin in terms of it moves around quite a lot, but within the range, but it's the people who are in it are holders. So they don't, they're picking up their dividend every year. They've probably been long-term holders. A lot of really big fund managers in there. They're who are very confident that, this thing will continue to outperform, going forward. So market gyrations are really not, nothing to be too worried about because it's a high quality business. And I think the same would go for, JB Hi-Fi as well. And look, Levisa's it's a growth story. That's it's beginning to be high quality. It doesn't have the same track record. Expansion at this stage, look, it's a bit of a market darling, but expansion at this stage, may be tough. If they pull it off, fantastic. If they don't, well, you might see some downside in those. But I mean, look, I think what will end up happening is, you be, as 8 kids and 2 adults to feed.
10, your numbers are off, pal.
Yeah, so you become more discerning. Like we shop at Kmart for essentials, or we buy on special and things like that. There's ways to, but things like Woolworths have mobile phones which give you a discount, and I think consumers will, they'll stop shopping for luxury brands or high-end brands and maybe just start accepting, slightly lower quality, or not cheaper, not lower quality in some cases. So, and then your spending will just direct somewhere else, I would expect. So.
Okay, so that's how you're viewing some of those retailers. Thanks for that, Mark. And you're welcome for those of you who really love stock conversations. But let's be real. It's all about the Fed, isn't it? It's all about what Jerome Powell says after this decision is made.
Yeah, there's 70, I think last check, 78% chance of 25 basis points. I think it'd actually be worse for the equity market if they don't go.
Yeah.
I think that will spark which is not a bad position for the Fed to be in realistically. They need to, their mandate's to fight inflation and control employment. It's not really their job to be fixing the financial system, even though obviously they have to be involved in terms of liquidity and things. So I think just doing what the ECB did, providing what was expected, is probably the best result for the equity market overall. But I think we'll, as we sort of start to look forward, I think we'll stop worrying about how high the terminal rate is now and probably start worrying about the first line of businesses that deal directly with the Fed is obviously the banks. And I think what you'll see is, banks' liquidity issues. They're not going to be lending. There's going to be less capital out there for businesses to use, and I think people will the market will switch within the next sort of month or so to focusing on, the recession that's obviously coming. I mean, if it's causing banking collapses, I think people will start to, go risk off, and we'll start to see spending, those rate hikes are really coming through, hitting consumer spending. When employment does turn around, we're at record lows at the moment. If you've had a look at any chart of, of unemployment rates after, sharp rate hikes cycles, it goes up fast, really fast. So, I think I think even if it reduces the amount of hikes left to come, I think, once that's passed, I think we start to worry about the health of the economy, because as you've seen in previous moves like this, banking sector is where it hits first, and then it filters out to the real economy over the preceding 2 to 3 months. So, I'm just remaining cautious, keeping high cash balances, just in case, and because I really don't see particularly something like the Nasdaq, even though those mega caps are very cashed up, they're all cyclical businesses. So, Microsoft, Amazon, Google, they're not going to be immune to an economic downturn. So buying into that as a safe haven is possibly, a little bit short-sighted. Although I do understand, given the gravity, the huge size of their balance sheets, why people perhaps ran to those mega caps, because they're sitting on piles and piles of cash.
What if they don't signal that they're open to cutting rates at some point? Because if you look at, say, Euro-dollar futures, implying a Fed funds rate potentially, or interest rates in the United States to be around 4% by the end of this year, and that cutting should begin in the middle of things. I mean, if they don't go that far, which is pretty extreme for them to do, effectively pivot, is that going to really rattle the markets? Because it's in the price, I would assume.
I think it's a very rare occasion where you probably should ignore the Eurodollars. The MOVE index is at bond volatility is at close to or near record highs.
Yeah. I saw an animation the other day of that curve and how it has moved. Well. It's crazy.
So I don't think, we're still having 25 basis point ranges of an evening in the US session for 2-year bond yields. So I think that's, you're cherry picking, probably saying, July cuts. I think that's more people were caught out, and they're still getting squeezed. I think that will normalise, because the Fed's not going to pivot in July. We're still at 6% inflation. So, and the target's 2. There's no way inflation. I mean, we only have 3 figures between now and then. So it's just it's impossible. But in bond futures and short-term interest rate futures, it's margin calls. You've got to get out, and that's what causes those massive overreactions. It's not really the same as equities, where you're playing with cash, like you're playing with highly leveraged money. So, if your clearer turns around and says to you, you must get out, well, you've got to get out or come up with the cash.
So is this going to be one of those things, considering that, obviously bond equities and other assets will take their leads from volatility in the bond market potentially, that we could have 3 days of trying to digest this, where things are going up and down and the narrative is, oh no, this is a good thing for markets, this is a bad thing for markets?
Yeah, I think we'll just see a lot of this for a while. And I think what the Fed needs to do is just play a very straight bat and just bring some calm back to markets. I mean, banking stocks have come back a little bit. Obviously, if we were going to pivot and 100 basis points of cuts was going to happen, well, these banking stocks would be a lot lower.
So safe to say, Mark, you are remaining defensive now heading into this meeting, but what you're saying, in essence, for viewers, is that you'll still be remaining pretty defensive after this meeting. Yeah,
I think it's definitely a bit of a situation where 20% cash, or we've got about 10 to 15% in investment grade and corporate bonds as well, because we've had a spike in the corporate bond yields, so locking in those really high rates there, and just sitting and waiting for the moment, because back in 2007 a couple of banks fell, and then then the Fed came and said basically that everything was okay. We went up sideways and rallied for a couple of months, and then it nosedived. So I'm not saying that's necessarily going to happen this time, but I think it just still, having a high cash balance as it stands to take advantage of opportunities and not get over allocated is probably your best play, because I don't think you're going to miss out on much to the upside.
So who's going to be on their Twitter when they roll out of bed tomorrow morning?
Yeah, exactly.
Come on, Kyle. Oh, he'll be in front of his screen.
I'll be here. I'll sleep under the desk tonight. How's that?
All right, Mark Gardner, Macro Capital. Always a pleasure. Thank you.
Cheers.
Let's get across what's happening overnight. I mean, do we even need to say it? We've got the Fed, we got the FOMC decision that's followed up by that usual media conference that's been held by the Federal Reserve Chair, Jerome Powell. What will he say? And, sloppy second, I guess you could say, UK inflation, but still a really important read.
Yeah, absolutely. I mean, obviously there's still a lot of, back and forth as to what the Bank of England could do, which is actually meeting in the next 24 to 48 hours night too. Yep. So something that will be influential there. But I guess those who are playing at home as well, the clock changes. I know this is a little bit irrelevant, but we had to change the daylight savings, so that meeting will be a little an hour earlier than what it would be otherwise.
Clocks change?
Well, no, we had daylight savings changed.
Oh, right, okay, right.
So
it's 6 o'clock is what you're saying instead of...
Yeah, it's 5 o'clock now.
Oh, it's 5 o'clock now?
Yeah.
Oh, God.
Anyway, if you want to get up to trade the thing.
I don't sleep anyways, it's fine. All right, let's get a look at what's happening tomorrow. We've got some company news, actually. Saul Pattinson reports, Brickworks does, Sigma Health, as well as Premier Investments. So we've actually got a little bit of corporate news on the horizon as well.
Yes.
Let's get across some of the leaders and the laggards on market today, starting with those leaders in the energy space.
You can see the theme.
Wow.
Absolutely, a bit of a bounce back there. Obviously, sort of taken to the cleaners, really, we've seen a pretty significant drop in the underlying oil price over the last few weeks. You can say even that perhaps these share prices have become somewhat dislocated from the underlying oil price at different stages. But, well, New Hope also delivered that update yesterday too, half-year results. So seeing another 4.5% gain to its share price.
We spoke with a really great guest. She's very insightful into the energy markets today. Her name is Vandana Hari from Vandana Insights, and that interview is up online if you would like to take a listen. I'm just noting that outside of the energy space, just for some color, we've got Mesoblast. It's up by close to 5%. So it's got, well, of course, it's some sort of release on FDA, license approval. This one, it looks as if it's just a licensing inspection, but it's just a very volatile stock on all of those news points, and data points that come from in relation to a drug approval. And Appin, I'm just sort of curious about. It's up by about 4%. It looks as if we've had some director buying, but I did have a chat with Grady Wolf from Bell Potter, or she's from Bell Direct. Bell Potter analysts have a sell on Appin. APX is the ticker code. So if you'd like to listen to a view from Bell Potter on 3 stocks, you can do so. It's up online, ausbiz.com.au.
Okay, let's look at the laggards now. And while we sort of foreshadowed it earlier, it was a weak day for gold miners. Actually, I wouldn't mind having a look at where they are over the course of the week if I can tap away here. But as you can see on the screen, the big laggards, Silver Lake Resources down by 6.03%, Regis down by 5.3. The overall gold sector for the day down 2.5, but for the week it's still up 2.3%. So still obviously benefiting from that bank instability as well as bets of rate cuts potentially.
Yeah, Gold Road actually has a bit of an investor presentation that's been released to the ASX. It's at an Ord Minnett mining conference. So if you'd like to get a bit more detail on Gold Road, you can do so. Kyle, I had a chat with Kanish Chugh from Global X ETFs about gold. Obviously, they've seen a lot of inflows into their gold, physically backed ETF. But we had a bit of a chat around silver, and we don't always talk about silver. I mean, it doesn't quite follow gold when it comes to safe haven status, as it's got industrial use as well. But that's an interview that you might like to catch up on if you got a bit of time.
Yeah, actually, and had Carl Kaplinger too on the trade, discussing some gold names as well. So, well, all the glitters, blah, 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 blah. So it was a good day for that.
Okay, in the small to mid-cap space, let's just see if we can find some stories here. Sezzle, it continues to transform the business, continues to pursue that NASDAQ listing, up by 10% today. And on the flip side of the equation, when it comes to the small to mid-cap space, Credit Clear it was on small caps yesterday. I hope that has nothing to do with its share price down by 8% today. And New Century Resources, it's got a bit of a bid on the table. I'm not sure if there's any movement in relation to that, but we'll be looking into it when we get off air for all of you small cap and mid cap lovers out there.
Absolutely. Well, I guess we should probably call it a day anyway, but what's it now? Countdown 24 hours, less than that, 12, I should say hours until the big decision. I've actually got Joseph Wang, Fed guy to those out on Twitter, but an ex-Fed trader talking about it on the big picture tomorrow, wrapping things up. So I'm very excited about that.
Looking forward to that. Look, a final figure for the S&P ASX 200, which is now closed up by 0.9%, 7,016, let's call it that, for the S&P ASX 200. Week to date, we're up by 0.3%. Who would have thunk it with all of the uncertainty, with this big risk event looming as well? We will see. 6 o'clock, you're telling me. 6 o'clock is when?
5 a.m.
5 a.m. Oh my God.
Set your dials, press conference, sort of 6 o'clock, whatever.
All right, it's been great to be here with you. We'll see you tomorrow morning.